Owning productive businesses. You can work your entire life and still stay poor, unless you own the thing you're working on. You've been taught that the goal is a higher salary, a better job, a promotion. But here's the glitch. Salaries cap, time caps, energy caps. Ownership doesn't. When you own a business, even a small piece, money is no longer tied to your hours. It's tied to systems, products, demand. That's the rule the system actually rewards. People who own assets that scale. That's why most wealthy people don't have impressive resumes. They have cap tables. This is why someone can take a vacation and still get richer while someone else works overtime and falls behind. The dangerous mistake is thinking ownership is only for the rich. It's not. Public stocks, private startups, digital businesses, even small equity stakes count. The moment you stop asking how much you get paid and start asking what you own, the game changes. But here's the question most people never ask themselves. If ownership is the real lever, why are you still trading all your time for money? Broad market index funds. The laziest investors quietly beat the smartest one, and it's not even close. And this one is uncomfortable because it sounds boring. You've heard about the S&P 500, you've heard about long-term investing, and you probably dismissed it. Too slow, too average, too safe. That's the normal explanation. The glitch is that boring is exactly why it works. Index funds don't rely on your intelligence, or timing, or emotions. They rely on one simple truth. The economy grows, companies innovate, productivity increases, and when you own the index, you quietly collect the upside of human progress. Most people lose money because they try to be smart. They chase stocks. They panic sell. They react. Index investors do the opposite. They do nothing, and nothing compounds. The system rewards consistency, not excitement. The dangerous mistake is thinking this is a small person's strategy. It's not. Pension funds, billionaires, endowments, they all use it, not to get rich fast, but to make sure they never get poor again. And that raises a deeper question. If doing less makes more money over time, why are you trying so hard to outsmart the market? Self-investment. If your income hasn't changed in years, it's not bad luck. It's your skill ceiling. This is where most people lie to themselves. They say they don't have money to invest, but they have time. And they waste it, scrolling, consuming, watching other people build lives they'll never touch. The normal explanation is lack of opportunity. The glitch is leverage. Skills create leverage. A high-value skill turns 1 hour into 10, or one action into 1,000 outputs. Coding, sales, AI systems, media, automation. These aren't jobs. They're force multipliers. This is why two people can work equally hard and end up in different universes. One builds a skill that compounds, the other stays replaceable. The rule is simple. The market pays for what is rare and useful. Not effort, not loyalty, not time served. The dangerous mistake is learning random skills instead of specific ones. Skills that feel like work to others but feel natural to you. When you invest in the right skill, money stops being the problem. It becomes the side effect. And here's the question that decides everything. If your income is a reflection of your skill leverage, what does your current income say about yours? Most people fail at investing not because they choose the wrong assets, but because they never fix the system underneath. Ownership, exposure, leverage, these are the real drivers. And we've only covered the surface. Because once you understand this layer, the next investments start to look very different. More uncomfortable, more powerful, and more dangerous if misunderstood. Which leads to the next question. If these are the safest foundations, what happens when you add leverage and risk on top of them? Rental real estate. The fastest way to feel rich isn't earning more money. It's having someone else pay your bills. Not because houses are magical, not because property always goes up, but because of one quiet advantage most people never see. Leverage plus cash flow. Real estate lets you control a large asset with borrowed money while someone else pays the debt down for you. Rent. That's the part people miss. The normal explanation is real estate is too expensive now. Rates are high. Prices are crazy. That sounds true until you notice investors are still buying. Not homes, systems, duplexes, small apartment buildings, properties where the math works even when emotions don't. The rule is this. If an asset pays for itself, time becomes your ally. Inflation shrinks the debt. Rents adjust. Equity grows quietly. The dangerous mistake is buying for appreciation instead of cash flow. That's speculation. Real investors buy boring properties that work on paper. And it raises a hard question. If someone else can pay your mortgage every month, why are you still paying yours with your life? Bitcoin. Bitcoin isn't an investment that makes you rich. It's insurance against everything going wrong. This one makes people emotional. They argue. They mock it. They dismiss it. The normal explanation is simple. It's too volatile, too risky, too speculative. But volatility is not the glitch. Time horizon is. Bitcoin was never designed to make you rich quickly. It was designed to protect you from broken money. Fixed supply, No central control, no dilution. That's the rule. In a system where dollars are printed endlessly, scarcity becomes valuable. The mistake people make is treating Bitcoin like a lottery ticket instead of insurance. They buy tops. They sell fear. They check the price every day. Long-term holders do the opposite. They buy small. They wait. They don't need it to replace the dollar. They just need it to exist as an alternative. And the real question is uncomfortable. If money keeps losing value quietly every year, where are you actually storing your time? Private startups and early-stage equity. Most people will never get rich because they never own things that can explode in value. This is where outcomes separate violently. Most people will never touch this category. They assume it's only for insiders, venture capitalists, Silicon Valley. But the glitch is access has already changed. Equity crowdfunding, angel platforms, even small checks can buy ownership now. The rule here is asymmetric upside. You can only lose what you invest, but you can gain multiples. This is how massive wealth is created, not by certainty, by distribution. Most startups fail. One winner pays for all of them. The dangerous mistake is betting emotionally instead of structurally, chasing hype, falling in love with ideas. Real investors look for teams, distribution, timing. They don't need many wins, they need one. And here's the question most people avoid. If owning a tiny piece of the future can change everything, why are you only buying things that depreciate? Cash flowing digital assets. Some assets clock out when you sleep. Others only work when you're gone. This is the quiet revolution. YouTube channels, newsletters, niche websites, software, communities, assets built once and paid repeatedly. The normal explanation is it's too saturated. Everyone's doing it. That's true and irrelevant. Saturation kills average work. It doesn't touch value. The rule is leverage through media and code. One piece of content can reach millions. One tool can serve thousands. There's no physical ceiling, no location limit, no boss. The dangerous mistake is treating these like hobbies instead of systems, posting randomly, quitting early, never optimizing. Real builders think in funnels. Attention, trust, monetization. They don't go viral, they go sustainable. And this leads to a sharp question. If the internet lets you build assets with almost no capital, what's really stopping you from owning one? By now, the pattern should feel uncomfortable. Ownership keeps coming up. Systems keep repeating. Leverage keeps showing its face. AI-powered businesses and tools. AI won't replace you, but someone using AI will. This is not about predicting the future. It's already here. AI is not replacing humans. It's replacing low-leverage humans. The normal explanation is that AI will kill jobs. That fear misses the rule. AI kills inefficiency. It multiplies output. One person with AI can now do the work of 10, sometimes 100. That's leverage. The people winning aren't engineers. They're operators who understand systems. They use AI to write, sell, design, automate, analyze. They don't compete with machines. They control them. The dangerous mistake is watching this happen instead of positioning yourself inside it, waiting for permission, waiting for clarity, waiting until it's obvious. By then, it's too late. So here's the real question. If one tool can multiply your output instantly, why are you still relying only on effort? Options and leverage trades. Leverage doesn't destroy people. Lack of control does. Options, controlled debt, strategic risk. This is where people either grow fast or blow up. The normal explanation is leverage is dangerous, and it is. If you don't understand it, the rule is simple. Leverage magnifies behavior. It doesn't create skill. It exposes it. Professionals use leverage sparingly, precisely, emotionlessly. They risk small to win big. Amateurs do the opposite. They risk big to feel something. The dangerous mistake is treating leverage like gambling instead of math. This layer is not for beginners. It's for people who already understand downside. Position sizing, rules, discipline. And the uncomfortable question is this. If leverage only destroys undisciplined people, what does your fear of it say about your control? Hard assets. If the system cracked tomorrow, most people's wealth would disappear overnight. Gold, silver, commodities, not because they make you rich, but because they stop you from becoming poor. The normal explanation is that these are outdated, slow, useless. That's because people expect growth from insurance. The rule is preservation. When systems break, hard assets hold value, quietly, while everything else panics. The wealthy don't bet everything on growth. They anchor part of their wealth in reality, physical scarcity, tangible value. The dangerous mistake is ignoring defense completely, assuming the system will always work. It never does forever. And the question you need to ask is simple. If everything failed tomorrow, what would still hold value in your life? At this point, the picture should be clear. Investing isn't about picking assets. It's about understanding the game. Ownership beats income. Leverage beats effort. Systems beat hustle. Every investment that works in 2026 follows the same rule. It scales without asking for more of your time. Miss this and no strategy will save you. Get this and almost any asset can work. Most people will still fail, not because they didn't watch this, but because they'll go back to playing the old game. Saving more, working harder, hoping longer. Once you see the system, you can't unsee it. But knowing isn't enough. Acting is where most people freeze. And if you want to understand the real reason money never sticks, watch the next video. Every money lie keeping you broke. Explained in 9 minutes.